Charlie Munger lived to be 99 years old. He spent his final decades thinking about death longer than most people have been alive. And that's exactly why he became one of the greatest investors in history. While young traders chase quick profits and quarterly earnings, Munger thought in decades. While Wall Street obsessed over next month's numbers, he asked, will this company exist in 50 years? This isn't morbid thinking. This is strategic thinking. Because when you truly understand that your time is limited, that businesses are mortal, that even the greatest companies eventually die, you make fundamentally different decisions. You stop chasing short-term excitement. You start building long-term wealth. You stop trading like you're immortal. You start investing like you understand reality. Most people avoid thinking about death because it makes them uncomfortable. Munger embraced thinking about death because it made him wise. He understood something that escapes most investors. Mortality isn't your enemy, it's your competitive advantage. When you accept that everything ends, you focus on what matters. When you acknowledge that time is finite, you use it more wisely. When you remember that death is certain, you stop making decisions based on fantasy and start making decisions based on truth. Today you'll discover why contemplating mortality makes you a better investor, why thinking about endings helps you build beginnings, and why the most successful people in history have one thing in common: they never forgot they were going to die. Steve Jobs was diagnosed with pancreatic cancer in 2003. Suddenly, the man who revolutionized technology had to confront his own mortality. What happened next changed Apple forever. Jobs stopped working on dozens of projects and focused on just a few. He eliminated everything non-essential. He streamlined decision-making. He prioritized ruthlessly. The result? The iPhone, iPad, and Apple's transformation into the most valuable company in the world. Facing death didn't paralyze Jobs. It clarified him. This is the mortality reality check. When you truly accept that time is limited, you stop wasting it on things that don't matter. Munger understood this principle long before any health scare. At 99, he spent decades watching businesses die, watching investors fail, watching brilliant people make terrible decisions because they thought they had infinite time. The psychology is simple. When you think you're immortal, you act recklessly. When you remember you're mortal, you act wisely. Young day traders risk everything on meme stocks because they believe they have forever to recover from losses. Experienced investors build diversified portfolios because they understand they have limited time to compound wealth. CEOs in their 30s chase growth at any cost because they think they can fix problems later. CEOs in their 60s focus on sustainable business models because they know later might not come. But mortality awareness isn't just about personal death. It's about understanding that everything dies. Companies, industries, investment strategies, economic cycles. Munger made billions by asking one simple question about every investment. What could kill this business? Not what could make it grow, not what's the upside, but what could destroy it completely. This question forced him to see risks that optimistic investors missed, to avoid companies with fatal flaws, to build positions that could survive worst-case scenarios. Because he understood that in investing, as in life, survival comes first, growth comes second. Here's what separates great investors from mediocre ones: time horizon. Mediocre investors think in quarters. Great investors think in decades. And nothing extends your time horizon like contemplating mortality. When you understand that you might die tomorrow, you stop waiting for someday and start investing today. When you accept that you won't live forever, you start building wealth that will. Munger made his greatest investments with this perspective. Coca-Cola, See's Candies, The Washington Post, businesses he expected to outlive him. He wasn't looking for quick trades or short-term profits. He was looking for companies that would compound wealth across generations. This approach requires a fundamental shift in thinking. Instead of asking, how fast can I make money? Ask, how can I build something that lasts? Consider the difference between two investment approaches. Approach A. Buy hot stocks, trade frequently, chase momentum, focus on next quarter's earnings. Approach B. Buy great businesses, hold forever, ignore noise, focus on next decade's value. Which approach feels more exciting? Approach A. Which approach builds more wealth? Approach B. The time horizon advantage works because it allows compound interest to work its magic. When you invest for decades, small differences in returns become massive differences in wealth. A 10% annual return for 30 years turns $10,000 into $175,000. A 12% annual return for 30 years turns $10,000 into $300,000. That 2% difference, which might seem insignificant year to year, creates an extra $125,000 over 3 decades. But most investors never experience this compound magic because they don't think long-term. They get impatient, change strategies, chase performance. Mortality awareness cures this impatience. When you truly understand that time is limited, you stop wasting it on strategies that don't work. You become patient not because you have forever, but because you know you don't. At 99, Munger wasn't investing for himself anymore. He was investing for generations he would never meet. This legacy mindset changes everything. When you're investing for yourself, you might take shortcuts. When you're investing for your grandchildren, you build for permanence. When you're managing your own money, you might accept higher risks. When you're stewarding family wealth, you prioritize preservation. When you're focused on your own lifetime, you might optimize for immediate gratification. When you're thinking generationally, you optimize for sustainable growth. The legacy mindset isn't just for billionaires. It's for anyone who understands that wealth building is a multi-generational project. Consider how this changes investment decisions. Short-term thinking. This crypto could 10x this year. Legacy thinking. Will this investment still be valuable in 2050? Short-term thinking. I need cash now, so I'll sell my winners. Legacy thinking. These businesses will compound for decades if I don't interfere. Short-term thinking. Everyone else is making money faster. Legacy thinking. Consistent returns over time beat spectacular returns, followed by spectacular losses. Munger applied this legacy mindset to every aspect of Berkshire Hathaway. They don't pay dividends because retained earnings compound better than distributed profits. They don't split stocks because high share prices attract long-term investors. They don't provide quarterly guidance because short-term predictions encourage short-term thinking. Everything about Berkshire is designed to outlast its founders. This approach requires sacrificing immediate gratification for ultimate impact, choosing boring consistency over exciting volatility, building wealth that survives market crashes, economic recessions, and personal mortality. The legacy mindset also changes how you evaluate risk. When you're investing for one generation, you might accept leverage and speculation. When you're investing for multiple generations, you focus on preservation and steady growth. Because families that maintain wealth across generations don't do it through spectacular bets. They do it through disciplined, boring, consistent wealth building. Markets die too. The dot-com bubble of 2000, dead. The housing bubble of 2008, dead. The crypto mania of 2021, dead. Every bull market eventually becomes a bear market. Every hot sector eventually becomes yesterday's news. Every sure thing eventually becomes a cautionary tale. Munger built his fortune by remembering this truth when everyone else forgot it. During the dot-com bubble, while others chased internet stocks with no profits, Munger remembered that businesses without earnings eventually die. During the housing bubble, while others believed real estate always goes up, Munger remembered that bubbles always pop. During the crypto boom, while others proclaimed this time is different, Munger remembered that speculation without value always ends badly. This mortality awareness protected Berkshire from every major bubble of the past 50 years. But understanding market mortality isn't just about avoiding bubbles. It's about recognizing when investment strategies reach their expiration date. Value investing worked brilliantly in the 1970s and 1980s, when many great companies traded below book value. Growth investing worked brilliantly in the 1990s when technology companies could grow without competition. Momentum investing worked during bull markets when everything went up. Contrarian investing worked during bear markets when everything went down. No strategy works forever because markets evolve, opportunities disappear, and what worked yesterday stops working tomorrow. Munger adapted by constantly questioning his own assumptions. He evolved from deep value investing to quality growth investing as markets changed. He didn't cling to strategies past their expiration date because he understood that in investing, as in life, adaptation is survival. This requires intellectual humility, the recognition that your current approach might not work forever, that market conditions change, that what made you successful in the past might destroy you in the future. Most investors struggle with this because success breeds confidence, and confidence breeds rigidity. They become attached to strategies that worked before rather than adapting to what works now. But Munger never fell into this trap because he never forgot that everything, including his own approach, was mortal. Before investing in any company, Munger performed what I call a business death audit. He didn't just ask, what could make this company grow? He asked, what could kill this company completely? This morbid question reveals risks that optimistic analysis misses. Consider Munger's investment in Coca-Cola. Optimistic analysis, global brand, addictive product, growing markets. Death audit. What could destroy Coca-Cola? Health concerns about sugar? Possible, but they have diet versions. Competition from other beverages? Possible, but their distribution network is unmatched. Changing consumer preferences? Possible, but they own hundreds of brands. The death audit revealed that Coca-Cola had multiple defenses against existential threats. That's why it became one of Berkshire's largest holdings. Compare this to companies that failed the death audit. Blockbuster could be killed by digital streaming. It was. Kodak could be killed by digital photography. It was. BlackBerry could be killed by smartphones with better apps. It was. Nokia could be killed by companies that understood software. It was. Each of these companies had obvious fatal vulnerabilities that optimistic investors ignored and pessimistic audits would have revealed. The business death audit works because it forces you to think like a competitor, a disruptor, or a changing world. Instead of asking, why will this company succeed? Ask, how could this company fail? Instead of focusing on strengths, focus on fatal weaknesses. Instead of assuming the future will be like the past, assume everything will change. This approach isn't pessimistic, it's realistic. Because in capitalism, every business is under constant attack from competitors, technology, regulation, and changing consumer preferences. Companies that survive long-term are those with strong defenses against multiple threats. Companies that die are those with single points of failure. The death audit helps you distinguish between the two. Memento mori, remember you must die, was a practice in ancient Rome where generals were reminded of their mortality during victory parades. The purpose wasn't to depress them, it was to keep them humble, focused, and wise. Munger applied this principle to investing. He never forgot that he was mortal, that his companies were mortal, that his strategies were mortal. This memento mori investment strategy has 5 key components. First, invest only in businesses you expect to outlive you. If you can't imagine a company existing in 50 years, don't buy it for 5 years. Second, focus on preservation before growth. Wealth you lose can't compound. Wealth you keep grows exponentially. Third, think in generations, not quarters. Ask, will my grandchildren thank me for this investment? Not, will this beat the market this year? Fourth, prepare for your own absence. Build investment systems that work without your constant attention. Choose businesses run by people you trust completely. Fifth, remember that time is your only non-renewable resource. Don't waste it on investments you don't understand or strategies you don't believe in. This approach created Berkshire's distinctive investment style. They buy businesses, not stocks. They hold forever, not until next quarter. They focus on what they can understand, not what's exciting. They prioritize capital preservation over capital appreciation. They build for permanence, not performance. The result? 6 decades of superior returns, built not on brilliant trades, but on wise thinking. The memento mori strategy works because it aligns your investment approach with reality. You are mortal, your time is limited, your companies might outlive you if you choose well. This perspective eliminates most investing mistakes. No day trading because you understand transaction costs compound against you. No speculation because you don't have time to recover from major losses. No chasing performance because you focus on long-term wealth building. No complex strategies because simplicity survives when complexity fails. When you truly internalize your mortality, investing becomes simpler, calmer, and more successful. Here's the paradox. Thinking about death makes you focus on immortality. Not personal immortality, that's impossible, but institutional immortality, building things that outlast you. Munger spent decades building Berkshire Hathaway not as a typical corporation, but as an institution designed to survive multiple generations. The corporate structure doesn't depend on any individual. The investment philosophy is documented and transferable. The culture values long-term thinking over short-term performance. Even after Munger and Buffett are gone, Berkshire should continue compounding wealth for shareholders. This institutional approach can be applied to personal investing. Instead of building a portfolio that requires constant management, build one that runs itself. Instead of choosing investments based on current trends, choose businesses with timeless competitive advantages. Instead of optimizing for maximum returns, optimize for consistent returns that compound reliably. Instead of creating wealth for yourself, create wealth that benefits multiple generations. The immortal perspective changes everything. You stop worrying about daily market movements because you know short-term volatility doesn't matter over decades. You stop chasing hot stocks because you focus on businesses with enduring competitive advantages. You stop timing the market because you understand that time in the market beats timing the market. You stop making emotional decisions because you optimize for outcomes you'll never see. This perspective requires tremendous intellectual maturity. You must care more about building something lasting than about immediate gratification. But the rewards are extraordinary. When you invest with an immortal perspective, you create wealth that survives market crashes, economic recessions, and personal mortality. You become part of something bigger than yourself. Charlie Munger understood that the best way to handle mortality isn't to deny it, it's to transcend it. To build things that matter, to create value that lasts, to invest in businesses that will serve future generations, to use your limited time to build unlimited value. That's why thinking about death makes you a better investor. Because when you remember you're mortal, you start building for immortality.